Hi and welcome to the Martin Bell Show. Hopefully you're keeping well, and in today's video I'm going to be reviewing a news article from the Daily Mail Online, and it's from the United Kingdom. And before I go any further, I'd like to announce that I am not a licensed professional. This is just me documenting my journey and also just sharing my thoughts with you and hearing your feedback. So the article today is talking about how the small investor or the small retail investor has ploughed £8.3 billion into funds in November. That's a lot of money, as the vaccine rally and US election lifted the spirits, but still pulled £425 million out of UK shares. Personally, I have added to my position in the FTSE 100, which is the top 100 publicly traded companies. I added it to my SIP, and if you're interested in seeing that, you can watch the video in my SIP channel where I've talked about that further, and also on my TikTok channel as well, which I think my TikTok channel is called The Martin Bell Show, or something like that. I'll have to put it in the description box below. So it says here, UK investors put £8.3 billion more into funds in November, II figures reveal. The global sector was one of the biggest winners with a record £1.7 billion inflows. But the UK stock market invested funds suffered another month of outflows. Investors rushed to plough money into funds as the vaccine rally and US elections arrived in November 2020. The latest data from the Investment Association has confirmed. The race to invest saw net retail fund sales reach a record monthly high of £8.3 billion, half of which went into equity, which is stocks funds invested in shares. The optimism driven by news of success with coronavirus vaccines and seemingly settled elections in the US. Joe Biden, despite President Trump disputing the results, they delivered a level of investment significantly higher than the previous record of £5.7 billion net retail sales in September 2017. Global equity funds were the biggest winner. That's because interest rates are really low and people are pushing more into equities, probably because the interest rate is really low, below inflation. With their own record-breaking net retail sales of £1.7 billion, but UK all-company funds continue to struggle with £425 million pulled out overall in November. I think that maybe people are trying to pull out of that one and trying to get more growth. That's my fault, but I can't confirm that. It's just me sharing that. At the moment I'm looking to increase my position for income, but I also will be looking for growth as well. A combination of both. So I will be looking into like a S&P 500 or a Nasdaq 100 or something similar like that. The figures are released with a time lag, and it remains pricing with anticipation of a potential deal followed by that coming to fruition just before Christmas. We see a reversal of fortune for the UK funds in December. Well, oh yes, this is a bit older news article. I just haven't got around to it just to now, so it is a little bit old. In the November stock market, invested funds as a whole did well, with a total net retail equity fund sales of £4.41 billion as investors bet on their way out of the coronavirus pandemic with news of a vaccine breakthrough. US politicians also have a big part to play in investors' confidence, as November saw Democrat Joe Biden's election victory over Republican Donald Trump. Despite President Trump disputing the election results, investors took it in that the matter was largely settled and another big stimulus package would be on the way, further boosting the share prices. Unsurprisingly, therefore, funds in the North America sector were the fifth best selling for the month, with the inflows of £533 million This is a huge increase from the mere £14 million in sales for US focused funds in October and outflow of £34 million the month before that. The second best selling sector for November was mixed investments, 40% to 85% shares, with inflows of £993 million, just under £1 billion, followed by a global bonds of £911 million. So large sums of money. The worst selling sector was the UK all companies, which is what I don't actually own, because I think that's a FTSE 350. I only at the moment have purchased FTSE 100, where outflows of £425 million. And it's still very liquid, that iShares FTSE 100. I think it's around £8 billion invested into that fund, so it's still very liquid. And the top companies, I don't see them going anywhere, especially with AstraZeneca being approved for the vaccine. It's very promising, and I do see the oil sector eventually will recover in the future. But I would like to see it eventually moving more towards renewable energies, but I do see it realistically. We always are going to need oil to some extent, but hopefully at a reduced rate or a severely reduced rate. But that's not something that's going to happen overnight, because they have to change their infrastructure. This follows from a loss of $240 million in the previous month. Shares lead the way out of this outstrip bond funds. In terms of asset classes, shares were the biggest beneficiary, with the stock market invested equity funds enjoying net retail sales of £4.1 billion. Fixed income also saw positive flows of £1.2 billion. Property funds, REITs, experienced net outflows of £147 million. Four leading open-ended property funds remain closed, including Janus Henderson, £1.8 billion, UK property, £2.1 million property portfolio. While global equity funds topped tables by a way, other regions also saw a positive flow, showing investors still believe in diversification. This is still the best medicine for a healthy portfolio, and I totally agree with that. My portfolio, my SIP is not diversified at this moment in time, but then again, I do not have a well-established portfolio, and I do not have large sums of money in there. I know £1,000 is a lot of money, but in the grand scheme of things, it will be expanded upon further, and obviously it costs £10 to purchase, practically £11 to purchase shares and £11 to sell, so it's not something I'm not buying and selling every now and then. I'm doing like a purchase once a month, and I'm not trading often, buying little bits here and there. I'm just like buying, I'm pound cost averaging, but not regularly, like daily, like a monthly kind of thing. So anyway, let's continue on. Asia funds were the second best sellers, with inflows of £688 million, followed by North America funds of £642 million. European funds were also in the green, with inflows of £244 million. From the UK equity funds, once again saw outflows of £461 million. Tracker funds saw £3 billion. Oh my, that is a lot of money. Excuse me, added in November, and a total of £251 billion under management. The overall share of the industry fund stands at 17.9%. Responsible investment funds continued their positive trajectory of £1.1 billion added, and funds under management stood at £43 billion by the end of this month. By the end of the month, their overall share of the industry funds under management was 3%. When will the tide turn on UK shares? The rush out of UK stock market invested funds was not as significant as the £782 million outflows in October, or the huge £1,047 million in June. I suppose that's when people needed the money, needed to cover some expenses, as obviously what people couldn't plan ahead what was happening back then. While we did not know yet the total flows for 2020, it was likely to remain in a negative territory for the UK equity fund, which is true when the data is released next month. Whether it will be higher or lower, but £1.235 million pulled out in 2019 remains to be seen. However, the start of 21 has seen a rush back into UK shares. This is what I mean, I think quite a lot of it is understandable if some people leave the money now and then, but if you're just trying to hop onto the next quick buck, that can be dangerous. It's just better to buy and hold and average out. In the long run, it's going to work out more likely to work out better for you. As I said, I'm not a licensed professional. This is not financial advice. So however, the start of 21 has seen a rush back into UK shares despite the fresh outlook of the back of the Brexit deal and optimism of the vaccine. The FTSE All-Share climbed around 6% in the first trending week of January off the back of this. This led to the question of whether the tide has finally turned for the UK stock market and the ahead will see more British companies. It does actually pay a nice dividend, the iShares FTSE 100. It was yielding around 3%, so that's pretty nice. It's a little bit low. I like it around the 4 to 4.5, but you can't take on too much risk. I am looking to like a high dividend yield ETF as well. Just a little bit more risk, but not too risky. But I'm more conservatively based, but as I get older, it will become even more conservative. And as my income becomes massively higher, I will be taking on less risk. Let's just have a little look, see what the comment section says. Some of them are good, some of them are awful. But anyway, if you like this content and you want to know more further, please feel free to comment. If you've enjoyed this video, please smash that like button. It really helps the algorithm know that my video content is good and it gets it out there to more people, and I really appreciate that if you could do that for me. And if you want to see more of my content, then please feel free to subscribe to me. If you click the bell notification button, that will notify you when I next release a video. I don't just do financial news, I do video games where it's relaxed. We don't talk about finances, and sometimes we do, sometimes we don't. And I also do, obviously, my portfolios for my SIP and my ISA. At this moment in time, it's just going to be I'm building up on my SIP because that's my long-term play, my SIP, my self-invested personal pension, and the ISA is more medium to long-term, and obviously the pension is long to longer terms. So thank you very much for watching. Hopefully you have a great day, take care and keep safe, and I'll see you all soon.